of what a trade setup is. For every single trade setup, we must know two things. First of all, we must understand where the market is at right now, and we must understand where we anticipate it to draw towards. This is our drawing liquidity. If we are bullish, we are anticipating the market to draw from this current market price level to the price level above market price. The difference between these two price levels is the range that we could look to profit from. If we are bearish, it means that we are looking for lower prices, and it means that we are looking at the price of the current market versus the anticipated price, which is below market price. The difference between these two prices is our potential range of profit. Inside of the difference between these two levels, we can look to capitalize on the market fluctuation. That is the overall idea behind every single trade setup. I know that this is a very simple explanation of getting into a market move and where you want to profit, but this is really the foundation. If you have been following me for a while, you will know that I trade purely based off market maker models. Therefore, we will discuss market maker models briefly so that you get a feeling of how I manage my positions within an overall market maker model framework. First of all, we're going to take a look at the buy model. What I want you to see is that we consolidate up here and the market begins to drop towards the downside. Eventually, the market reaches a key level, and once this key level gets reached, we see the following occur. We see the market displace above the high, which set up the final run lower into the key level. The market displaces above that high, and when this occurs at the right time, and I see that we have likely formed the SMR, the smart money reversal within a market maker buy model, I will look to go long inside of the retracement into the fair value gap that will form during that expansion leg higher. This fair value gap must function as support on price. The reason why is because that fair value gap sets up the displacement above the high, and therefore I know that we have now changed from a sell program into a buy program. My stop loss will either be placed below the swing low, which formed at the key level, or I will place it below the low of the bullish breaker. The market then begins to expand away from our entry into our anticipated direction. During this expansion leg, something of great importance will occur, and that's the following. We will see a bullish fair value gap get created. This bullish fair value gap must function as support on price in order for the market to continue higher to draw towards the original consolidation, its respective high. This means that we can then trail our stop loss all the way to the low in which we entered in the first place. But this allows us to do something, and that's the following. This allows us to enter again into a long position because we understand that this bullish fair value gap should function as support on price. When the market then expands away from this fair value gap and draws towards our original consolidation, I need you to understand what we have just done. We have just not only removed risk from the equation behind this trade setup, but we have also given ourselves the opportunity to pyramid into this position. Pyramiding is something that we will discuss later during this video more in depth. We can not only look at a bullish example, so we also need to look at a bearish example. For bearish examples, I look at market maker sell models. What I want you to see is that the market consolidates and eventually begins to reprice towards the upside. The market reaches a key level, and this is my point of interest. When I see the market form a swing high at this point of interest during the right time, and I see all of the algorithmic signatures that I'm looking for to confirm that we're forming that high, followed by displacement to lower, I will seek to find an entry inside of the retracement into a bearish fair value gap, which will form during that displacement leg lower. This lines up with a bearish breaker, which formed. That will be my first entry. My stop loss will either be placed above the swing high, which formed inside of the point of interest, or I will place it above the bearish breaker. When I then see the market expand away from my entry and a new bearish fair value gap forms, I need to see this bearish fair value gap function as resistance on price. If this bearish fair value gap does not function as resistance on price, and I see the market displace above the high in which I entered, that's a big warning sign to me to cut the trade. If I see the market, however, find resistance inside of that bearish or value gap, I can look to pyramid inside of that bearish or value gap. But that's again something which we'll discuss later. My stop can be trailed to the high in which I entered. When the market then expands in our favor, we will look for it to reach or draw liquidity, which is below the original consolidation, and when it does, that's the idea done. When it comes to taking profits, a lot of traders seem to believe that they should take their full position off at once. This, however, is not true. Partials are a great benefit for your own psychology because partials allow you to slowly get comfortable with holding on to full targets. When you have a clear draw on liquidity that you are targeting, but you see signatures in advance of that draw on liquidity that you are not a fan of seeing, it is never a bad thing to take a partial because that allows you to already pay yourself and to be content with the outcome of the trade regardless. Meaning, if the market reverses on you and draws back to your entry, at least you have covered commissions and you are in profit for that session or that day. And therefore, taking a partial is always a good idea when one of the following signatures is in play. First of all, when the market is failing to displace true equilibrium of the range from the original consolidation, its respective low or high, to the smart money reversal, its respective high or low. When you see the market fail to displace true equilibrium of this range, it's a warning sign that the market might want to fall back all the way back to your entry. When the market fails to displace true 50% of this range, it's a warning sign that the market might want to roll over back to your entry. When this occurs, the worst thing that you can do is hold on to your position. Why? Because you could easily have taken a partial due to that warning sign and at least covered commissions. If the market then displaces true equilibrium of that range, we can look for the market to draw towards the original consolidation. Here we need to pay attention to intermarket relationship, however. If we see a highly correlated market take out the original consolidation, whilst the market that we are trading on does not, that's a warning sign for us to take a partial, because it's possible that they're setting up SMT there to then draw against our position. This is something that I had to encounter many times in the past, where I was targeting an original consolidation and I saw the market simply stop right in advance of it and then roll over all the way back to my entry. When I then looked at the highly correlated market, I saw that the highly correlated market already took out the original consolidation, and that was SMT playing out. Therefore, the moment that you see a highly correlated market take out the original consolidation, whilst the market that you're trading on does not, it's always a good sign to take a big partial. When it comes to take profits, I need you to understand that there are multiple protocols that can be applied.